Hello, everyone. I want to start today with a number that, honestly, when I first saw it in the research, I thought it had to be a typo.
Oh, yeah. It really does sound like a glitch in the Matrix.
I mean, I actually went back and checked 3 different sources just to be absolutely sure.
I don't blame you.
Right. We're talking about stories circulating of people turning $12 into $200,000,
Yeah.
or people claiming they pay their entire monthly rent. And we're talking in a major city, mind you, just by using this, new financial strategy.
Which is wild.
It's completely wild. It's not real estate, it's not traditional stocks, and it's definitely not a savings account.
No, it's a space that sits in a very strange, kind of a gray area of the financial world.
Yeah, but before we tear this apart to see if it's genius or a scam, hello to everyone listening. You're on the Smart Capital School of Financial Literacy channel.
It's great to be here, and today we are doing a deep dive into the exploding world of prediction markets.
Prediction markets.
Yeah.
Even the name sounds like something out of a sci-fi novel.
It does, yeah.
But the reality is a lot grittier. We're seeing reports of young traders, people who maybe have, never bought a mutual fund in their entire lives, emptying their savings accounts to bet on, well, literally everything.
Anything and everything.
Right. Who wins the Oscars,
Mhm.
whether a CEO gets fired, or if a specific politician says a specific word during a speech.
Like a catchphrase.
Exactly. Or if a vape company is going to relaunch a mint flavor. It's crazy.
It's a massive shift in capital, and our mission today is to figure out what this actually is for you, the listener. Is this the future of investing?
Yeah.
Is it a clever loophole to legalize gambling? Or is it a trap designed to wipe out the wealth of a generation that's, frankly, already struggling?
That's the big question. Because on the surface, it looks like trading. It smells like trading. But let's be honest. If I put money on the Super Bowl coin toss,
That's gambling.
that's just gambling.
Yeah.
So how are these platforms, places like Kalshi or Polymarket, operating legally in the U.S.?
Well, that is where the legal gymnastics come in. To understand why this is allowed, you have to understand the specific mechanism they are using. They aren't selling you a bet. They are selling you an event-based futures contract.
Okay, stop right there. Event-based futures contract. That sounds like jargon designed just to keep regulators happy.
Oh, it absolutely is.
Break that down for me. How does a trade actually happen?
It's surprisingly simple, which is part of the allure. Imagine a question like, will it rain in New York tomorrow?
Okay,
In a prediction market, there are 2 shares you can buy, yes and no.
simple enough.
The price of those shares is always between 1 cent and 99 cents. If the market thinks there is a 60% chance of rain, the yes share costs 60 cents.
Got it.
If you buy it and it rains, that share value goes to exactly $1. You make a 40-cent profit.
And if it doesn't rain?
The share price goes to 0. You lose everything.
So it's completely binary. All or nothing.
Correct. And unlike a casino, there is no house setting the odds. In a casino, the roulette wheel has a 0 and double 0.
Right, that's the house edge.
Exactly. Here, the price, that 60 cents, is determined entirely by other people buying and selling. You aren't betting against the platform, you are trading against another human being who thinks you are wrong.
So if I buy yes at 60 cents, some other guy's out there buying no at 40 cents.
Precisely.
Okay, I get the mechanics, but I'm still stuck on the legal part. If I'm betting on rain or who wins a Grammy, how is that not just gambling? I can do that in Vegas. Why is this treated like a financial instrument?
Because of a concept called hedging. The legal argument, and this is what got these markets approved by regulators, is that they serve a genuine economic purpose for businesses.
The sources mentioned this car wash analogy. Is that the main defense?
It is. The argument goes like this. Imagine you own a car wash. Your entire livelihood depends on sunshine.
Right. If it rains, nobody's coming.
Your revenue drops to 0 for the day. That is a significant business risk.
Yeah, you can't control the weather.
But with a prediction market, you could technically hedge that risk. You could buy, yes, contracts on rain. If it's sunny, you make money washing cars and you lose a tiny bit on the contracts.
That's just the cost of doing business.
Exactly. But if it rains, you make a massive profit on the contracts, which offsets the money you lost by not washing cars.
Okay, I see the logic there. It stabilizes your income. It flattens the curve.
And there is precedent for this. This is exactly how grain futures started. Farmers needed to lock in prices in case the harvest was bad.
Oh, sure.
The Supreme Court eventually ruled that while it looked like gambling on wheat prices, it was necessary for the economy.
That sounds noble. Really, it does.
Hmm.
But let's be real for a second. I looked at the activity on these platforms in the research. I saw contracts for, will Taylor Swift announce a tour date in November?
Right.
And will this specific YouTuber get banned? Are you telling me there are businesses out there hedging their risk against Taylor Swift's tour schedule?
And that is exactly where the theory falls apart. The lawyers went to court and argued, this is for the farmers, this is for the car wash owners.
Yeah.
But then the app developers went to Silicon Valley and basically said, build me something that looks like TikTok but takes credit cards.
So the interface isn't built for hedging at all.
Not at all. The reality on the ground is that almost no one is hedging a car wash. The vast majority of the volume is pure speculation on pop culture, politics, and viral news.
So we have a financial instrument, approved for businesses, but it's being used by teenagers to bet on internet drama.
That is a very fair assessment, and it explains why the behavior is shifting so dramatically. We are seeing a generation that is actively pulling away from the traditional stock market.
This was the part of the research that really worried me. Why leave the stock market? I mean, it's not perfect, but it's how wealth has been built for 100 years.
Well, put yourself in the shoes of a 25-year-old today. The traditional stock market feels rigged. It feels opaque. You have high-frequency trading algorithms.
Hedge funds with supercomputers.
Dark pools. If you buy a stock, you have to understand PE ratios, earnings reports, supply chains. It's heavy.
It feels like homework.
And it feels like a game you can't win, but a prediction market. That feels intuitive. If you are obsessed with pop culture, you might look at the Grammy odds and say, I know who's going to win Album of the Year.
Yeah.
I know this better than some guy in a suit on Wall Street.
You feel like you actually have an edge.
You feel like the playing field is level because you understand the asset. It's easier to predict a celebrity breakup than to predict the 10-year earnings growth of a semiconductor company.
But that feeling of, I know this,
Yeah.
is it translating to actual wealth? Because the stats in the source material were terrifying.
It is terrifying. The data shows a direct cannibalization of savings. For every $1 a household spends on this type of betting, they put $2 less into their legitimate investment accounts.
Wait, repeat that. It's not just that they're spending fun money. They are diverting serious money.
Yes, net investments fell by 14% among this group. They are rating their future to fund these bets.
Why? That seems so irrational.
Is it, though? Think about the economic context. We have a housing market that feels completely inaccessible. Inflation has eaten away purchasing power. If you truly believe that saving $500 a month into an index fund will never actually buy you a house, the slow and boring path looks like a trap.
It feels futile.
Exactly. So the psychology shifts to perceived scarcity. If you can't get rich slowly, your only hope is to get rich quickly.
Right.
High risk, low probability bets, moonshots start to look like the only rational move.
It's financial nihilism. Like, I'll never own a home anyway, so I might as well try to turn this $100 into $10,000 overnight.
That's the mindset. And the platforms are designed to exploit that desperation.
But does it work? We started this deep dive with the story of the guy who turned $12 into $200,000.
Yeah.
That's the poster child. But what about everyone else?
Before we get into the grim reality of the math, I think this is a good moment to pause.
Thank you for joining us. Let us know in the comments how you like this format of video analysis and what topics you'd like us to cover in future videos.
Now let's look at the actual success rates. Because for every viral screenshot of a massive gain, there are thousands of silent losses.
Okay, let's hear it.
On one of the major platforms, Polymarket, the data indicates that 70% of traders lost money.
70. 70%. That is catastrophic.
It's extremely high. And the distribution of winnings is even starker. Only 0.04% of traders captured 70% of the total profits.
Wait, hold on. Less than 1/10 of 1% of the people are taking almost all the money.
Yes, it is a massive transfer of wealth from the many to the very, very few.
And on the other platforms, is it any better?
On Kalshi, the bottom quarter of users lost about 28 cents for every dollar they bet.
28 cents on the dollar.
To put that in perspective, that is mathematically worse than playing slot machines or blackjack at an online casino.
Oh, wow.
The loss rate on standard gambling sites is usually around 11 cents per dollar.
That is unbelievable. People are leaving casinos because they think this is smarter, but they're actually losing money faster.
Yes. And we have to explain why. Why is it harder to win here than in the stock market? It comes down to the difference between a positive-sum game and a zero-sum game.
Okay, break that down. The stock market is positive sum.
Generally, yes. When you buy a share of Apple, Apple actually does things. They sell iPhones, they make profit, they innovate, the company grows,
How posh gets bigger?
the pie gets bigger.
Hmm?
Over a long enough timeline, it is possible for you to win, me to win, and the bank to win.
We all ride the wave of the growing economy.
Exactly. But a prediction market is a strict zero-sum game. Actually, it's a negative-sum game once you account for fees. There is no underlying business. There are no dividends. There is no growth.
The pie is fixed.
The pie is fixed. For you to win $1, someone else must lose $1. You are not investing, you are battling. You are trying to take money out of someone else's pocket.
And when you factor in the fees, the platform taking their cut, the pie actually shrinks every time a trade happens.
Correct. So mathematically, the average user has to lose. It's unavoidable.
This brings me to the way these apps feel. We talked about gamification earlier. I remember when Robinhood came out, they had the confetti animations when you bought a stock. These prediction apps feel even more like video games.
That is entirely by design. They have borrowed the entire playbook from the gambling industry and Silicon Valley engagement teams, push notifications, bright colors, behavioral nudges to keep you active.
Because they make money on volume. They need you to trade.
And it works. The data compared trading volume across platforms. Robinhood users, who are already considered hyperactive, traded 9 times more than E-Trade customers.
Wow.
But on these prediction markets, the volume can be even higher.
It's the dopamine loop.
It is. And the most dangerous part is that technology has removed the friction. A few years ago, you had to physically go to a casino to gamble or log into a sketchy offshore site. Now your investing app is right next to your betting app on your home screen.
Or the investing app is the betting app.
Exactly. The mental barrier between building a future and getting a rush has completely evaporated. It's all just numbers on a screen.
I want to go back to that 0.04% number, that tiny group of people making all the money.
Yeah.
If this is a zero-sum game and most people are losing, these guys are the sharks eating everyone else.
Yeah.
Who are they? Are they just lucky?
In a game of coin flips, luck dominates the short term. But to win consistently? No, that's not luck, that's information. This leads us to the wildest part of this industry, which is insider trading.
Now, in the normal stock world, insider trading is a crime. If the CEO of a company tells me they are about to go bankrupt and I sell my stock, I go to jail.
Correct. The SEC policies that very strictly. It's based on material non-public information. But remember, these prediction markets aren't regulated by the SEC. They are regulated by the CFTC as derivatives.
And the rules are different.
The rules are very different. The source used a great analogy, the Walmart parking lot.
How does that work?
If you sit in a Walmart parking lot and count the cars to estimate how much money they made this quarter, that's just smart research. It's legal.
Sure.
But if you work at Walmart and you see the spreadsheet before it's released, that's illegal insider trading.
Okay, that makes sense. Fiduciary duty and all that.
But in a prediction market, let's say there is a contract for will Lady Gaga perform at the Super Bowl?
Okay.
Who knows the answer to that before the public? Her manager,
Right.
her backup dancers, the lighting crew.
Right.
Do those people have a fiduciary duty to the general public to keep that secret? Not really. Not in the financial sense.
So if a backup dancer knows she's rehearsing and they go on Kalshi and bet $5,000 on... Yes.
It's a gray area, but generally it's happening. And it's not just pop culture. There was a case where a trader made a massive timely bet that the U.S. would invade Venezuela just moments before the news broke.
That is incredibly shady. You're telling me people with sensitive geopolitical info are monetizing it on these apps?
It appears so.
Yeah.
And here is the twist that really blew my mind. The platforms, and even some economists, argue that this is a good thing.
How on earth is insider trading a good thing?
They call it the efficiency argument. They say that for a prediction market to be useful, it needs to reflect reality. It needs to be a barrier of truth.
A barrier of truth.
Think about it. If the backup dancer bets huge on Lady Gaga, the price of the yes contract shoots up to 99 cents. The market is now signaling to the world, this is happening.
So the market becomes accurate.
Exactly. The source highlighted a statistic. 4 hours before a contract ends, the leading outcome is correct 94% of the time.
94%. That's better than any poll. That's better than the news.
It is a truth machine.
Oh.
But it's a truth machine powered by insiders taking money from outsiders.
That is the key, isn't it? If I'm a regular guy sitting on my couch and I think I know what's going to happen, I'm not just betting against another guy on his couch. I'm betting against the person who wrote the script.
You are the sucker at the table. You are providing the liquidity for the person who already knows the answer to cash out.
So when we see these whales making millions, it's not because they are geniuses at predicting the future. It's because they are the future. Or at least they have the script.
In many cases, yes. It is a game of information asymmetry, and the average user is on the wrong side of that asymmetry.
So let's bring this home for the listener. We've got a system that looks like investing, acts like gambling, but has worse odds than a casino, and is filled with insiders who know the outcome before you do.
When you sum it up like that, it's pretty damning.
What is the takeaway here? Is there any safe way to use these?
We have to separate entertainment from wealth building. If you want to put $50 on the election because it makes watching the returns more exciting, fine. That's entertainment. That is the price of admission, same as a movie ticket. Assume that money is gone.
But don't call it a strategy.
Never call it a strategy. Do not confuse it with investing. If you are trying to build wealth, the math is strictly against you.
So we are back to the boring stuff.
The boring stuff is the only stuff that works. Investing in index funds, buying assets that produce cash flow, paying down debt, these are positive-sum games. You don't need someone else to go broke for you to get rich.
It's the get-rich-slow scheme.
It is the only real asymmetric bet available to normal people. You have unlimited upside over 30 years, and the risk is managed. Betting on a coin flip, even if you think you know which way the wind is blowing, is just churning your capital until it's gone.
Before we go, I want to loop back to that truth machine idea, because I can't stop thinking about the implications.
It is a provocative thought.
If these markets are 94% accurate because insiders are signaling the truth with their wallets, are we moving toward a world where the news doesn't matter?
We might be. Imagine a world where you don't wait for the press release to find out if a CEO is fired. You don't wait for the vote count to know who won the election. You just look at the price of the contract.
The price is the news.
Exactly. Money doesn't lie. People might lie on TV, politicians might lie in speeches, but they generally don't lie when they are betting their own cash.
That's dystopian, but also kind of efficient.
It is. But it raises huge ethical questions. If the market knows the truth before the public, does that break our trust in the system? And if we start relying on betting markets for our facts, what happens when someone decides to manipulate the market just to create a fake narrative?
We could see fake news attacks that are actually fake market moves. Someone dumps $1 million to spike a price just to make people think something is happening.
That is a very real danger. We might be trading one set of problems for a much more volatile set of problems.
Well, on that slightly terrifying note, I think I'm going to keep my money in the boring old S&P 500 and just watch the prediction charts from the sidelines.
I think that is a very wise decision.
Thank you for watching this video to the end. Subscribe to the channel, like it, and see you in the next retelling.
Goodbye, everyone.